Hi there. Thanks for stopping by the Equity Trust Virtual Classroom. My name is John Bowens, and in this segment, we're going to talk about how to fund your self-directed IRA, self-directed Roth IRA, or potentially self-directed solo 401k. We're going to share with you 4 funding methods. The first funding method is an employer-sponsored plan rollover. So that's moving money from an account like a 401k. A transfer from an existing IRA, that is moving from one financial institution to equity trust into a self-directed IRA to be able to invest in assets like gold and silver and real estate, private placements, and other alternative assets. A contribution, that is taking money out of pocket and simply contributing to the account. Or a Roth conversion, that is converting funds from a traditional IRA to a Roth IRA. So let's kick it off with the rollover from an employer-sponsored plan. So when you hear employer-sponsored plan, you would want to think a 401k, or maybe you don't have a 401k or are offered a 401k. Maybe you have a 403b. Maybe you have a 457. For example, police officers and firefighters, they don't get a 401k through their municipality government or the institution they work for. They get a 457, or maybe a thrift savings plan. If you work for the federal government, you aren't offered a 401k, but rather offered a TSP, thrift savings plan. Now, these are employer-sponsored plans. There are other employer-sponsored plans, by the way, but for all intents and purposes, these are the major ones, the most common ones we see. And so the natural progression is when you leave the company or you retire or attain the age of 59 and a half, those are known as qualifying events. The normal progression is to initiate a direct rollover. So I'm going to write this down for everybody. Very important to write this term down, direct rollover. See, you never want to distribute the money and then try to return it to a retirement plan. There are ways, by the way, in which you can do that. It's known as a 60-day distribution rollover, but there can be tax consequences. So what's important to understand is to write down and remember direct rollover. So you're going to open up your self-directed IRA. You're going to reach out to your plan administrator, whether it be a 401k, 403b, 457 thrift savings plan. There's a third-party administrator that is overseeing that plan for you. You're going to reach out to them and you're going to initiate a direct rollover. And then those monies will never pass through you. They're going to go directly from your plan into your self-directed IRA. That's really critical that you initiate the direct rollover in this fashion so that you don't create any adverse tax consequences or penalties. Now, what happens if you're still working for the company that sponsors one of these plans and you are a participant of the plan? Well, if you're still working for the company, seldom can you roll the money over into an IRA. There are some exceptions to this general rule. This is known as what's called an in-service rollover. In-service rollover. So you're going to write that down, in-service rollover. What this means is while you're still working for the company, they may allow you to roll the money over into an IRA. Now, don't get your hopes up because oftentimes you cannot, but you can give it a shot. You can call up your plan administrator and ask if you can take an in-service rollover. At the age of 59 and a half, which is the qualified retirement age in the United States, many plans do support a 59 and a half in-service rollover. So if you're somebody that's 59 and a half or older, you got a much better shot, even while you're still working, to be able to roll the money over while you're still working through this in-service rollover. And remember, when you're ready to do this, you want to make sure you call your plan administrator and initiate a direct rollover. So step 1, open your account with an equity trust company. We'll help you complete the application if needed over the phone. And from there, you'll call your plan administrator and initiate a direct rollover. Keep in mind that when moving from one financial institution to another, it's generally speaking not an overnight process. It could potentially take 3 to 4 to upwards of over a month to get money moved from point A to point B. So you want to make sure you start that process well in advance, particularly if you're investing in very time-sensitive investment opportunities. For example, gold and silver, with valuations potentially rapidly changing, you want to make sure you start this process well in advance. Or for somebody that might be investing in real estate, timing can be very critical in executing on a real estate transaction. So you want to make sure that the account is set up and funded well in advance. All right, so in summary, employer-sponsored plans initiate a direct rollover to the self-directed IRA. And you would do this through a direct rollover. You want to make sure you use that terminology. If you're still working for the company, call up and ask if you can do an in-service rollover. If you have employer-sponsored plan funds that are tax deferred, those will move over to a traditional IRA. If you have Roth funds, those will be rolled over to a Roth IRA. All right, let's move on now to the IRA to IRA transfer. So if you have an IRA with another financial institution, you're simply going to initiate a trustee to trustee transfer. There's no tax liabilities, there's no penalties. You're simply moving from one account to another. So for example, let's say you have an account at XYZ Financial. XYZ Financial, you have an IRA. We're going to call this a traditional IRA. And let's say you have $100,000 in the account. Step one, you would open up a self-directed IRA with Equity Trust Company, and then you would transfer those funds into the self-directed IRA. No tax consequences or penalties, of course. Now, you don't have to move the entire $100,000. Maybe you just want to move over $50,000 to start with, and then maybe move over more at a later date. You can transfer and roll over as a direct rollover as many times as you need to throughout the year. It is important to understand that if you took a 60-day distribution rollover, that you can only do once in a 12-month period. And that's a common point of confusion for folks, is that they can only roll over or transfer money one time in a 12-month period. That is only what is known as a 60-day distribution rollover. So if you took the money out of the account and then wanted to return it to a qualifying account within 60 days to avoid any tax consequences or penalties, that you could only do once in a 12-month period. This here is a trustee to trustee transfer, or as we talked about in the rollover section, a direct rollover. So that's 60 days, and that once in a 12-month period does not come into play. All right, so that's a transfer. The next is a contribution. So this would be out of pocket. Now, self-directed traditional IRAs and self-directed Roth IRAs have different rules in terms of contributions. And that's not just self-directed, that's any IRA for that matter. That's just the law. So if you want to contribute to a traditional IRA or a Roth IRA, you have to have earned income, number one. Number two, if you want to contribute to a Roth IRA, if you make too much money, then you may not qualify to make a direct contribution to a Roth IRA. You may have to initiate what's called the backdoor Roth contribution, which is first contributing to a traditional IRA and then converting to a Roth IRA. And we have additional training videos specific to this backdoor Roth contribution approach. Of course, we'd always encourage you to speak to your tax professional or CPA as you navigate these scenarios and determine what's going to be the best fit for you. Contribution limits to a traditional or Roth IRA can vary depending on the year in which you're making the contribution. So you're going to want to go to irs.gov and look up in the applicable year that you're watching this video, what is the annual contribution limit for an IRA in that individual year. So traditional IRAs and Roth IRAs have the same contribution limits. Solo 401ks or 401ks in general have different contribution limits. Keep in mind that you can contribute to both a 401k and an IRA in the same year. They're two totally separate accounts. That's a common misconception that I hear in the industry, is that if I'm contributing to my 401k with work, or maybe I have a 401k for my own business, I'm excluded from making a contribution to an IRA. You can contribute to both your 401k and your IRA in the same individual year. So contributions to an IRA is simply taking money out of pocket and making a contribution. Traditional IRAs, as we talked about in our traditional versus Roth IRA training video, traditional IRAs are tax deferred. You get a deduction going in, it grows tax deferred. You take money out, you pay taxes. A Roth IRA, you fund it with after-tax dollars, it grows tax-free. You take the money out, and it's tax-free distributions. All right, last but not least, let's talk about the Roth conversion. Roth conversion. So this is where if you have traditional IRA funds and you say to yourself, you know what, I would rather pay taxes on the seed than on the crop, you can convert your traditional IRA funds to a Roth IRA. Now, you might convert your entire traditional IRA, or you might just convert a portion of your traditional IRA. That is entirely up to you, and you can convert as many times throughout the year as you like. So let me give you an example of how this works. Let's say you have $100,000 in a traditional IRA, and you would like to convert the $100,000 to a Roth IRA. So you convert the $100,000 to a Roth IRA, and you're going to pay taxes based on your effective tax rate. So $100,000 converted to the Roth, $100,000 is going to be added to your 1040 as ordinary income, and then you're going to pay taxes accordingly. So hypothetically, let's say you're at a 20% effective tax rate. So 20% of 100,000 is $20,000. So you're going to pay $20,000 in taxes to get the $100,000 into the Roth account. Now, you might be saying, well, who would want to pay $20,000 in taxes to put the money into the Roth account? Well, some investors would prefer to do that because they may forecast that they're going to grow the Roth in such a significant way that they would pay less in taxes on the seed than the much larger proverbial crop down the road. Now, that's not always fact for every investor, right? Some investors might have less money later on to withdraw from. And obviously, your tax basis could determine whether this makes sense or not. But if you're an investor that feels strongly that your tax rate will go up, that your tax basis will go up, that you'll pay more in taxes in the long run, then it might behoove you to work with your CPA or tax professional to convert some or all of your traditional IRA funds into your Roth IRA. And again, like I said, you don't have to convert the entire traditional IRA. You might just convert a portion of the traditional IRA into your Roth IRA. So those are the 4 funding methods that we had for you today: a rollover from an employer-sponsored plan, a transfer from an existing IRA, a contribution, or conversion from a traditional IRA to a Roth IRA. I hope you enjoyed this video. You can check out additional videos on traditional and self-directed Roth IRAs and other account types on our YouTube page. I encourage you to subscribe to the Equity Trust YouTube page as well for all of our upcoming and ongoing video support. And until the next video, keep leveraging compounding interest in the absence of taxation.